Right. Good morning, everyone. I'm not sure who's there. Do we, 15, 18 people are just coming in. That's great. We can see you guys streaming in. I'm so excited about today's event. If there's one thing that, real estate and investing in investments and leveraging my home, waking up my lazy asset is been a great thing for me. It's kept the pounds off my butt, and so I brought in a couple experts, which I'm super excited about. And with me, I have Kelly Wilson and Robinson Smith. And I would love Kelly. I'm going to introduce you first, and then you can introduce Robinson. Kelly is with the Wilson team, a phenomenal mortgage broker, and her team is amazing. She's also an investor in real estate, lives and breathes the things we're going to be talking about. And Kelly and I have partnered on a few buildings in the past. Right now, I don't think we have any real estate together, but that'll happen again. And so, Kelly Wilson, take it away.
Hi, thank you very much. And great to see everybody again. We're really excited about this presentation because I truly believe that this strategy that you're about to learn is a game changer in people's lives and building wealth. We're even more excited to have Robinson Smith here, who is the best-selling author of Master Your Mortgage for Financial Freedom. He's a best-selling author, and he's also the president of the Smith Consulting Group. So we're really excited that you've taken time out of your busy schedule to come and hang out with us and share this amazing strategy with everybody. So I am going to send it over to Robinson.
Okay, well, thank you, Kelly. Thank you, Ken. A pleasure to be here. I always like talking about this stuff. I hope I look okay. It's 7 a.m. here in Victoria, BC, and my hair and makeup people didn't agree to come this early, so I had to do it all myself. But welcome, everybody. Yes, I am the author of Master Your Mortgage for Financial Freedom. There it is. Never miss an opportunity. This is a follow-up book to my father's book, which came out in 2002. My father, Fraser, was a financial planner based in Vancouver, BC, back in the mid-'80s, and he developed a strategy for his clients. He put his private clients into it for about 15 years before he retired to write his book. But retirement didn't suit my old man, so he came back into advising in 2005, and I joined him in 2006. So we were investment advisors here in Victoria. We were putting our clients into the Smith maneuver, which we'll talk about. And yeah, I was an investment advisor for a dozen years before I retired from that, sold my business so that I could get word out to Canadian homeowners coast to coast about this strategy, because it is not easy out there, as you are all very aware. It's not getting any easier for Canadians. But we've got a solution that can help many people. Prior to being an investment advisor, I was living in China for a while. I've got a double major in economics and Chinese studies and MBA in international business. And I lived in Beijing for about 6-7 years, investment banking, working at the Canadian Embassy for a while. But yes, I was very pleased to come back to Canada. And so ever since my return, I've been educating Canadians, helping them implement the strategy, training financial professionals in it. I won't go too much into my background here. I think that's all I'll say, because I want to get into the strategy here. And you folks are about to learn, if you haven't heard about this strategy already, you're about to learn how you can significantly improve the lives of your clients while significantly adding value to your business, which I hope is all to all of you is a very important motivation for doing what you do, is helping your fellow Canadians get better off, buying their principal residence, creating wealth through their investment properties. You're about to learn how you can help them create wealth, not through investment real estate, but also, in addition, through creating value from their mortgage on their principal residence. So we're going to be talking about the Smith maneuver here. Let's jump into it. What are the issues faced by your clients? Well, all Canadians, not just your clients, but you deal with Canadians every day, and they're seeing the same things. Increasing job insecurity, high inflation, pension insecurity. We see all the time in the news about how pension systems are moving from defined benefit to defined contribution. And this is to the employee's detriment, not benefit. Corporate pension plans are massively underfunded. Your clients are also facing economic uncertainty, cost of housing. But when your clients do look at how they can increase their wealth, what's holding them back? Insufficient salary and wage increases. We see this all the time as well. High taxation. We Canadians pay around half of our income in tax. That is more than we pay in food, clothing, and shelter combined, the simple necessities of survival just to be able to continue living, right? We're consistently around the top 5 highest tax-paying citizenry on the planet. It's ridiculous. We pay so much in tax. We've also got the cost of life. Not only are our individual expenses increasing, but we're also incurring as we move through life more different types of expenses. We're single, then we're married, then we have families. And these mortgages that we have to incur to buy our homes. A $450,000 mortgage, you'll see here, it costs over $1 million over your lifetime to be able to pay that $450,000 back. Why? You borrowed $450,000, you got to pay that back, but you also have to pay the interest on that. But before you can make those principal and interest payments, you have to pay tax. So it's hugely expensive out there, and it's keeping Canadians back. Now, we Canadians, we have 2 major goals in our lives. One, we want to get rid of our expensive mortgage. It's killing us. Rightly so. We want it gone. But 2, we also want to save for our future. But the decision on which of these goals we attack first is made for us, not by us. Because if we don't take our cash and invest for our future, nobody cares. But if we don't make our mortgage payments, somebody certainly does care, right? They're going to come knocking on our door. So that's what we do. We Canadians, we focus on paying out the mortgage at the expense of not getting invested for our future. And where does that lead? To a number of potentially really bad places. I'm sure we all know someone who's got a home, they're clear title, they got hundreds of thousands of dollars in equity, but they're living on a fixed income. Why? Because they subscribe to that traditional notion that they must be clear title by the time they retire. So all their money went towards their mortgage. They didn't invest for their future. They're living off CPP and OAS. Or they're financially reliant on their children. They're forced to downsize. They have to sign up for reverse mortgage, or they have to work in retirement, right? When you walk into Costco, Walmart, Burger King, have a look around. And from now on, you will notice many, many senior citizens working in these places. They're there because they have to be there, not because they want to be there. They'd rather be playing with the grandkids, golfing, gardening, traveling, but they can't. So we're going to show you how you have the ability to talk to your clients about how you can address their concerns. So quickly, what is the Smith maneuver? This is a strategy that's designed for your principal residence, the home in which one lives. Okay, and it's a mortgage conversion strategy. A mortgage is expensive. It's non-deductible. You cannot deduct the interest on it, but we're going to change that. And your clients are going to see 3 big benefits right off the bat. Reducing their tax bill, they're going to get rid of their mortgage much quicker than otherwise, and they're going to enjoy the value of compound growth through their investments. These benefits start now, they occur simultaneously, they improve exponentially, and the big one here is no new cash is required from your homeowner on a monthly basis, right? The strategy is using cash that your client is already outlaying. And it's maximizing the mortgage debt that they already have in place. It's just a one-time restructuring of their existing financial affairs. And this is where someone like Kelly Wilson comes into play here. They have to have the right type of mortgage, we'll talk about this, in order to implement the strategy. And before I go on, I just want to say, when people do try to look at how to improve their personal finances, they talk to a traditional investment advisor. What do they hear? They hear, hey, in order to be better off, what you got to do is you got to max out your registered contributions. You got to invest more into non-registered accounts. You want to prepay your mortgage. You want to pay off your consumer debt. And the problem with all these traditional strategies is they require additional cash flow from your clients' pockets. And no one has additional cash flow these days, right? So it's unattainable. Well, where this strategy comes in is it does not require additional cash flow on a monthly basis from your clients. So as I talked about, in order to implement the strategy, you need the right type of financing. And this is, excuse me, when someone thinks about a mortgage, this is what they think about. I get a down payment together, I go to the bank, I borrow $500,000, I buy that house. And that's what it looks like. And this is a traditional mortgage All of this debt is non-deductible. You cannot deduct the interest that you're paying on this from your income. Why? Because the government considers you to have borrowed to consume, right? You're going to consume that asset, your home. But in order to implement the strategy, so they need a readvanceable mortgage. And again, this is where Kelly comes into play. She gets the clients the right type of financing. And it looks like this. We've still got that $500,000 mortgage balance over here, but we also got this line of credit which is attached to it. Now, all readvanceable mortgages, and there's a number of them out there, they're all different some way or another. But the fundamental principle is they've got these effectively at least two components. One is going to hold my mortgage debt, and the other is a line of credit which the homeowner can access. Now, once they have the right type of financing, thank you, Kelly, your client is now going to have a mortgage payment. In this case, $2,200 a month. They had a mortgage payment before, they still have a mortgage payment, but out of that $2,200, let's say $1,260 goes to interest. Okay, that's interest on this $500,000 worth of debt. It's non-deductible, it's expensive, that money is gone, they will never see it again. But 940 does reduce the principal. Down that balance goes by 940. And the way a readvanceable mortgage works is the lender says, hey, we're willing to lend you $500,000. And if you pay 940 down, we're going to allow you to borrow it back. So the limit on that line of credit increases by 940. Dollar for dollar, goes down by 940. You can borrow back that 940. Now, a lot of Canadians have a readvanceable mortgage. They don't necessarily know they do. They don't know what it is. They don't know why they have it, how to use it effectively. So they get their monthly statement and they say, wow, I paid down 940. Yeah, I was expecting that. But now I got this line of credit and I can pull out 940. Wow, okay. And that seems to be happening every month. Well, that's about how much it cost me to lease a BMW 5 Series. So off they go, they get a car, right? Or they spend it on vacations or clothing or dinners out. So they're borrowing back expensive debt that they just paid down. So the use of these available funds is critical. You want to do the right thing with it. When we're talking about the Smith maneuver, you're going to pull it out to invest. And you do this on a monthly basis. So you make that mortgage payment, you pay it down, you pull it back to invest. And over time, this is what happens. I'm paying it down the bad debt, I'm pulling back good debt. So by the time I've completely converted my mortgage, that non-deductible mortgage debt is gone. I still have that debt, but it's all tax deductible. This is doing fantastic things for my tax bill. It's 100% tax deductible. And because it's tax deductible, I've received refunds each year that otherwise I wouldn't have received from the CRA. Because every 2 weeks, the government, I get my paycheck and I look and it says, oh, the CRA took a bunch of money from my paycheck. Well, when I send my tax return in at tax time, the CRA says, oh, looks like we took too much money from you every 2 weeks over the past year. Here's money back. And the client, your client would not have otherwise received this refund. They take that refund and they prepay the mortgage each year with it, pull that amount back and invest it as well. So they're out of their mortgage faster than otherwise they would be. And the client has taken advantage of compound growth. Why? Because every month they've been pulling the available funds out to invest. Stocks, bonds, mutual funds, mix, REITs, private lending, investment real estate. They can do whatever they want with that available money. They can invest it where they're comfortable, but they have to borrow to invest with a reasonable expectation of generating income. That is when the CRA says we can deduct the interest. And yes, they still have this debt after they've completely paid off the bad debt, but it's offset by a significant investment portfolio, right? I might have $500,000 worth of debt, fully tax deductible, but it has allowed me to accrue an investment portfolio over time of $900,000. So the Smith maneuver converts your client's 100% non-deductible mortgage to 100% tax deductible debt. Each month, they're generating valuable and increasing tax deductions. Their tax refunds get larger and larger and larger each year. And they're able to get rid of their mortgage much quicker than otherwise possible. And they're investing money they wouldn't otherwise have available. You know, if you're paying attention here, you would have noticed that they're making that $2,200 mortgage payment. Whatever is reduced on principal, they're pulling that back out to invest. So the money to invest is coming from their mortgage payment, which they were making whether they were engaged in the strategy or not. So no new cash is required from your client on a monthly basis. Well, what's it worth? Well, for the typical Canadian homeowner, the plain Jane Smith maneuver is worth around several $100,000 and about 2 or 3 years off the amortization. And again, this is generated from no additional cash flow from their pockets. And the plain Jane Smith maneuver is what we just talked about. All they're doing is using the mortgage payment they're making anyways, but with the appropriate financing, they're able to access the principal reduction, access the equity that they create each and every month with the regular mortgage payment, and get it invested. Now, you folks are realtors. You understand very, very clearly the value of getting equity put to work, right? If you do not put your equity to work in your home, what's it earning? 0%? No, it's earning less than 0% because of inflation. So you've got an opportunity to show your clients, hey, how would you like to earn 6, 8, 10% rather than lose 5, 4, 5, 6% on your equity? So plain Jane Smith maneuver worth several $100,000, 2 or 3 years off the amortization. But there are a number of accelerators that may be available to these homeowners, which can improve these results. And we regularly see projections of over the typical 25-year amortized mortgage. We're seeing net worth improvements of over $1 million for people, and their amortization is reduced to less than 10 years. So instead of 25 years, Kelly might get them a 25-year mortgage, but that expensive non-deductible mortgage debt is disappeared in 6, 7, 8 years. So this is where your client's eyes really widen. So these accelerators, what are they? There's the cash flow diversion. There's the debt swap, the drip, prime the pump, cash flow dam. And we're just going to have a quick look at 2 of these accelerators, the prime the pump and the cash flow dam, because this is where your client can really use investment real estate to speed up the process of mortgage debt conversion. So prime the pump. At refinance, client goes to Kelly. Kelly says, okay, we're going to put you into the right type of mortgage. It's a readvanceable mortgage, etc. But there's a good chance that the homeowner has significant available equity that they can access to invest right away. $50,000, $100,000, $200,000, they can get that invested. And the prime the pump accelerator involves pulling this equity out to invest anywhere they wish. But to someone like yourself as a realtor, you may be interested in talking to your client saying, hey, you don't have any investment real estate. Would you like your first piece of investment property? They could invest in mutual funds or seg funds or ETFs or whatever. But if your client is interested in investment real estate, this is where you could provide significant value and add significant value to your business as well. Now, when the client pulls these available funds to put to work, it's important that they use it for the correct purposes. And if they borrow that money to invest in something that has a reasonable expectation of generating income, such as a rental property, then it's tax deductible. And when I pull $50, $100, $200,000 to invest in something that qualifies for tax deductions, I am doing fantastic things for my tax bill. Really, really good things for my tax bill. My refunds are significant. And these larger refunds I receive each year from the CRA, remember, I'm using my refunds to prepay my mortgage, get rid of it faster. So that really increases the speed at which non-deductible mortgage debt is retired. So let's say someone wants to implement the Smith maneuver. You send your client to Kelly. Kelly says, well, if I'm going to put you into the right type of mortgage, we need to appraise the house. Well, the house comes in at $625,000. As most of you will know, for a readvanceable mortgage, the lenders will only go up to a maximum of 80% loan to value. So they're willing to lend a total of $500,000 on this $625,000 house. Well, it just so happens that this homeowner already has a house. They're refinancing out of the wrong mortgage into the right mortgage, but their mortgage balance is $500,000. So at refi, this new mortgage lender pays out the old mortgage lender that doesn't work for the strategy. And so that $500,000 of non-deductible mortgage debt resides here now on the readvanceable mortgage. But they've borrowed the maximum amount that the new lender is willing to offer them. And so they don't have anything available immediately on this line of credit. However, what happens if Kelly goes through the process for your client and it turns out that their house is worth $850,000? Well, the lender is willing to go up to a total of $680,000, but they only have to pay out $500,000. That's what their mortgage balance currently is. So that $500,000 of new mortgage debt, well, existing mortgage debt, now resides here on that non-deductible side of the mortgage. But the lender says, hey, we've paid out $500,000, but we're willing to lend you a total of $680,000. So we're going to let you pull out right away 180 grand. Now the client doesn't have to do anything with this immediately available equity. The last thing they want to do with it is pull it out and buy a brand new Corvette, right? Or go around the world 4 times, because that is the non-deductible use of funds. What they want to do, if they want to borrow all of it, some of it, or none of it, again, that's up to them. But if they're inclined, they can pull some or all of this to invest in securities, private equity, new business, private lending, maybe buy their first piece of investment real estate, maybe buy their second piece of investment real estate. Let's say they do. Okay, so first off, when they do pull this out again, this is additional borrowing, but it's fully tax deductible. So again, they're going to see good things on their tax bill at tax time. They pulled it out. They've increased their wealth by buying a new asset, this investment property. That's the first accelerator in this example, prime the pump. This refi has enabled them to access equity and put it to work for them, in this case, a rental property. But now they have the ability to implement another accelerator, and that's the cash flow down. Now, instead of the typical flow that a Canadian goes out, they buy a rental property, they install some renters. Let's say they get $3,000 a month in rent. That money comes in to the bank account they've opened up specifically for their rental property, but then $3,000 goes out because they got a mortgage on that rental property. There's maintenance, there's property tax, there's all these different expenses, maybe utilities. So in this case, revenue, cash flow neutral, $3,000 in revenue receipts, $3,000 in expenses goes out from the same bank account. But what they can do, if this rental property or if this asset is held as a proprietorship, when that $3,000 comes in, they can first run it through their mortgage and pull it back out and then service the expenses. This borrowing is tax deductible because they're borrowing to invest in a business which generates income, their rental property. And because they're prepaying their mortgage by a significant amount each month, we're seeing many, many years taken off the amortization of that non-deductible mortgage debt. So as I mentioned, someone goes and gets a rental property, they open up a bank account for that business, they get renters, $3,000 comes in, $3,000 goes out. Next month, in, out, in, out. But what happens if they implement the cash flow down? Well, they're still getting $3,000 in rental receipts, that arrives. But what they do immediately with that $3,000 is they make a prepayment against their mortgage. This is the house in which they live, their non-deductible mortgage. They're still making a mortgage payment, but now they've got an additional $3,000 to prepay. And just talking about this prepayment, this overpayment each month, after that $3,000 gets paid down against that mortgage balance, that line of credit opens up by $3,000. If you pay it down, they'll let you borrow it back. And therefore, that's what the homeowner does. If your client pulls that $3,000 back out, sends it to that bank account for their rental property, and then they make the payments on that rental property. So again, $3,000 in receipts, it's coming in, $3,000 in receipts is going out to service the expenses, but they're prepaying their mortgage and pulling it back first. And Kelly will tell you that if you're prepaying a mortgage, in addition to your mortgage payment, $2,000 a month, let's say, if you're also sending another $3,000 against that mortgage, it's gone in no time. This is where we see a 25-year mortgage gone in 6, 7, 8 years. And people love this. They hate mortgages. They love it when they're gone. So this is very, very powerful. And again, each month when the client pulls that $3,000 back out, they're servicing the expenses on their rental property. They're investing in their business. Because they're investing in this business, the interest on this $3,000 each and every month is tax deductible. And this occurs every month. Down this goes very quickly, up this goes very quickly. So you can see how their tax deductions are going to increase. This is why their tax refunds get bigger and bigger and bigger each year. So would you like to be able to educate your clients that they can invest each month new money that they otherwise wouldn't have available, that they can generate valuable and increasing tax deductions, they can eliminate their expensive mortgage in record time, they can start to accrue these benefits now, and they can do this without additional cash flow required on a monthly basis. No new cash flow. They don't have to go out and find another job to generate more money to increase their wealth. They don't have to sacrifice their standard of living to generate wealth. They can do it with Kelly's help through a simple restructuring of their existing financial affairs. So I want to talk a bit about the Smith Maneuver Certified Professional Accreditation Program. Why are we all here today? As mentioned, my dad developed a strategy back in the mid-'80s. He wrote his book. It came out in 2002. So for about 40 years now, there have been a lot of financial professionals across the country, whether they're mortgage brokers, investment advisors, whatever the case may be. They're saying, hey, Canadians, we're going to put you into the Smith Maneuver. And what we found is that a lot of these professionals were telling their clients they're going to put them in the Smith Maneuver, but it wasn't the Smith Maneuver. It was either a little bit wrong or it was a lot wrong. And this is no good for anybody. So when I came out with my book at the end of 2019, I also started up the Smith Maneuver Certified Professional Accreditation Program. So we're training up realtors, mortgage brokers, investment advisors, insurance brokers, accountants, all the different types of financial professionals that a Canadian should surround themselves with anyways, doing the strategy or not, as far as I'm concerned. They're being trained up specifically in the Smith Maneuver. So now these Canadian homeowners have professionals they can go to that they can trust, understand the strategy, who are going to be there for them over the long term while they go through this process, and who know each other. You know, the SMCP, the Smith Maneuver Certified Professional Realtor, knows the SMCP broker, knows the SMCP investment advisor, knows the SMCP accountant. And the clients love that. They love the fact that all the professionals they're using know each other, communicate, they understand the strategy, they know where the client is going. That way the client doesn't have to educate their mortgage broker, their investment advisor, their realtor, their accountant, all this. So we've got close to about 85 Smith Maneuver Certified Professionals from Victoria to Halifax at this point. More are coming, they're in the program, they haven't completed it yet. But how does membership in this network improve your real estate business? And this, I'm not trying to sell you folks on becoming an SMCP. That was a complete lie. I actually am, but I'm here for Kelly. But the reason I'm interested in realtors and becoming SMCPs is because Kelly needs someone to cooperate and collaborate with, share their database with, do presentations for. All the Canadians that I talk to, whether it's in my book or presentations or on YouTube or wherever they're seeing this, I'm telling Canadians, do not use any professional who's not an SMCP. And it's not because I'm trying to take business away from people who know what they're doing. It's just, I don't know who knows what they're doing. So we're getting them trained up. We want the Canadians to be certain that they're dealing with professionals who understand the strategy. But for a realtor, a lot of differentiation. Okay, in Ottawa, around that area, there are hundreds, if not thousands, of realtors, and everyone is competing for clients. By who has the brightest smile on the bus shelter poster. I know the local market because I live in the local market. It's tough to get business, but has your competition bothered to learn a strategy that could be worth hundreds of thousands, if not millions of dollars to them? Are they educating their clients about this, right? It's a significant value add touch point for your entire database. You become an SMCP. Hey, everybody, all 700 people of you in my database, guess what? This is who I am. This is what I know. This is what the strategy is about. This is what it can do for you. Contact me for more information. We're going to really build out your investment real estate portfolio. And it's novel and social media content. Canadian homeowners, when they hear something about the strategy, something like this value add from someone they're not expecting to hear it from, like a realtor, it's quite powerful, right? So a lot of differentiation. As an SMCP, you can collaborate with other SMCPs. In Ottawa, we got Kelly's a mortgage broker. We got an investment advisor, SMCP. We've got an accountant. We've got these different professionals that you now have access to, co-marketing events, right? So you want your clients to get into investment real estate. Kelly can finance them, get them that equity. They can buy their first piece of real estate and start to generate wealth. And you're sending clients around to each other. Now, I want to show you the Smith Man calculator. This is just a quick video demonstration, but this is what we've developed, which in relatively quick amount of time, you can show your prospective client what the Smith Maneuver can do for them. So I'm going to hit play here. And if for some reason you can't hear me, Stephen, please let me know.
Okay, Due to time constraints, this is going to be a very, very fast demonstration of Smithman calculator. So once in, I'm going to give it a name, this scenario, and we're going to head to the calculator. We can enter various types of income. I'm going to throw in $150,000 of employment income. I've also got a rental property proprietorship, and it generates $36,000 in rental revenues per year. And it costs me $34,000 a year to service the expenses on that rental property. I'm also going to input that I have $30,000 of mutual funds invested. And I've also got a $10,000 emergency fund. And down here we can see my marginal tax rate is 45.8%. I'm going to go to the next sheet. I'm going to fill in my house value at $750,000. The mortgage balance on that is currently $450,000. The interest rate is 2.9%. The amortization defaults to 25 years. On the readvanceable line of credit side of things, I've got a prime rate of 2.45 and a premium of 0.5% for a total of 2.95%. Next, I'm going to go to the fund page where we start to see results. I can throw in whatever I project my investment to grow at on an annual basis. We'll leave it at 8%. This is saying the very first month's mortgage payment leaves me $769 to invest. I'm going to go ahead and invest that all. Here's where we start to see some results. Taxation improvement, total deductions over the amortization of the mortgage of $109,000, which lead to total in tax refunds of $50,000. No amortization improvement yet, we'll see that soon, but a net worth improvement of $388,000 already at this point. Now here I can adjust the amount that I accept from the lender. They're willing to lend a total of $600, but I can move that up or down and we can see the results change. I won't go into an explanation on this right now, but let's just say I only want to accept $550,000 from the lender. So we've seen a bit of improvement in the results. Here's where we'll see amortization improvement. If I apply my annual tax refunds as a monthly prepayment against that an annual prepayment against that mortgage, and also reborrow that to invest, we'll see amortization improvement and also net worth improvement here. 2.33 years saved off my non-deductible mortgage, net worth improvement up to $551. The debt swap accelerator, I've got $30,000 that I already inputted in mutual funds. I'm going to go ahead and debt swap that and watch the results here. The years saved and net worth improvement. There we go, 4.6 years saved, net worth improvement of $791,000. I'm not going to input any future lump sums. What I'm going to do is debt swap my emergency cash. I'm going to secure a line of credit, a personal line of credit that I'm only going to use for emergencies. Therefore, I can debt swap this cash. I can prepay my mortgage and then get it invested. And we're going to see further results here. Cash flow diversion. Let's say I have been investing $300 on a monthly basis. That's how I built up my $30,000 in mutual funds. So I'm going to go instead apply that as a prepayment each month and then reborrow it to invest. 5.42 and 869 it goes to 8.42 and net worth improvement of $1.164 million. Cash flow dam accelerator. I previously entered my rental revenues and expenses, and that works out to $3,000 a month in revenues and expenses of $28.33. If I implement the cash flow dam accelerator, we're really going to want to watch this one here. Instead of saving 8.42 years off that mortgage at this point, I'm saving 18.25 years, which means my original 25-year amortized mortgage is going to be gone in 6.75 years. Dividend reinvestment plan accelerator, I won't go there at this moment. Prime the pump accelerator. Based on the numbers inputted, apart from that non-deductible mortgage debt when I refinance into a readvanceable mortgage, I've also got $100,000 of immediately available funds with which I can prime the pump. So I can withdraw some, all, or none of this if I wish, but if I do, I'm going to get this invested immediately. So if I pull $50,000 of this to prime the pump, then we'll watch the net worth improvement go from 1.3 to 1.7. Now I've saved 18.5 years off my mortgage. I've received total tax refunds over the course of the mortgage of $145,000. And again, instead of 25 years, that mortgage has gone in 6.5 years. So this net worth improvement, this is net worth improvement, meaning I've got an investment portfolio of $2.21 million offset by a 100% tax deductible investment loan of $484,000, leaves a net improvement of $1.726 million. And the next screen here, that just shows the graph. The green line descending at 25 years to the x-axis is a 25-year amortization. This blue line hitting $0 is the reduced amortization of my mortgage. The red line over here is my investment portfolio. The yellow line is my total debt. And then I can view and print a report, which is going to summarize the results. It's also going to give me my instructions for the monthly process of the Smith maneuver based on my numbers. So there you go, a quick demonstration of the Smithman calculator. Okay.
All right, we're back live here. So we're going to get into the Q&A, but I'd like to thank you, Kelly, for organizing this, and Ken for collaborating with Kelly on this, and making sure that that your folks are at least aware of the strategy and how it can help their fellow Canadians. So I'm going to stop the screen share here, and we're back live.
Can you hear me? Or...
I can hear you, Kelly.
Okay. Yeah, I just wanted to say something really quickly before you get into the Q&A. Just remember that equity sitting around your house is, it's doing nothing, right? So we get really excited to pay it down, but then you've got hundreds of thousands of dollars sitting around losing value. And if you think about the way you can use your property, it's almost like, I like to call it a bit of a washing machine cycle. So everything that you're doing currently now can be put through the primary residence. So if you're currently investing, well, don't go from net dollars of income directly to the investment now. We want to take that, you know, as was shown in the example, take that $300 a month you're currently putting away and put it through the property first, pull it back out, then invest it. If you're getting rental income, instead of going right and paying it directly to your expenses, put it through the property. If you're doing prepayments on your mortgage, you know, keep doing that, and then being able to pull it back out, at least, you know, you're going to feel good about that prepayment. So anything that you would normally do, it doesn't require additional funds, but the idea is to convert that debt as fast as possible. And it's lost opportunity cost. You know, we have clients that I just spoke to not that long ago. We're 50 some years old. We've just paid off our mortgage. You know, we made our last payment. I'm super excited, but I have no money invested. So where do we start? We're basically starting new with a Smith maneuver strategy, where, you know, we to get to the end and have everything paid off with not enough to retire. You know, we're working backwards. It's possible, you know, we can get it done with these types of strategies, but that's why each client is different, because when we sit down with somebody, we're looking at the whole financial plan. Do you currently have existing investments? Where are they sitting? We're looking at tax implications. Even finding where to invest is important as well, because we, you know, as you know, property is a really tax efficient investment in general, investment property. So we're looking at the whole portfolio and the whole financial plan, and then figuring out, okay, based on all those things that Robinson showed you, the different ways that you can utilize it, how can we tap in? Can we use one? Can we use three? So it's really, really important to go through that whole strategy and financial planning. And it was a lot to take in. I get that, because, you know, so just running out and getting a line of credit and trying to implement this yourself is going to be a lot, because you have to have systems set up and you have to know exactly where the money is going and how it's being moved around. So I will go back to you, Robinson, to answer any questions.
Yeah, thank you, Kelly. Yeah, we'll get into questions now. So if you do have any questions, please put them in the Q&A box. But it is so important for a Canadian to use someone who knows what they're doing. This is where professionals get into trouble, is they read half the book, and they start putting their clients into the Smith maneuver. They don't understand what they're doing. They can't advise the client appropriately and properly on process and tracking and reporting. And it's dangerous for everybody involved. You know, if I'm going to go out and buy a brand new Ferrari, I'm not going to take it to Joe's garage, you know, on the corner of the street. I take it to a dealer. I get someone to take care of it who knows what they're doing. We're talking about other people's money, their financial lives, their security. And so it's very important to have a fulsome understanding of what you're suggesting, recommending, putting them into. Okay, so there's a couple questions that Kelly already answered on the Q&A, but just to touch on them, can the money pulled be parked in a TFSA? Registered investments, TFSA, RSP, these types of investments, if you borrow to contribute to your registered investments, the government, the CRA does not allow you to deduct the interest. So with the Smith maneuver, you're not converting your debt, which is, this is what the Smith maneuver is debt conversion, non-deductible to tax deductible. And if you pull it out to contribute to a registered investment, you're not creating those tax deductions. So the reason is the CRA is already giving you lots of good things with a registered investment, either tax deductions on the initial contribution, tax-free growth, tax-free withdrawal, depending. So they're not going to give you the additional benefit of tax deductions, and that's fine. Any good accountant is going to tell you that it's best to have a mix of registered and non-registered investments. And this is not an either-or strategy. If someone's already contributing $300 a month to an RRSP, for example, once Kelly gets them into the right type of financing, they have another $1,000 to invest each month. So that $300 that has been going into an RRSP continues to go into an RRSP. That doesn't change, but now they have access to another $1,000 that they can contribute into on a monthly basis into a non-registered account. Can it be used for non-real estate investment? Yeah, I think I touched on that. If you borrow to invest with a reasonable expectation of generating income, and this has been around forever, the CRA allows you to deduct the interest. So I can borrow to invest in mutual funds, stocks, bonds, investment real estate, mix, REITs, ETFs. There's a wide universe of investments which qualify for tax deductions. However, it's not that simple because, as you recall, you have to have a reasonable expectation of generating income. Someone might think, well, I'm a gold bug. I'm going to pull money from my house and I'm going to buy gold bullion. Well, you don't expect to generate income from a lump of metal that sits in your safe. So you can't deduct the interest. Raw land, in many cases, you can't deduct the interest. Raw land, where's the income coming? So there's a lot of things, and this is why SMCP accountant, SMCP investment advisor, and all these different types of professionals are very important. Open questions here. What's the difference from a HELOC? This is very, very important to understand. And this is where so many people go wrong. Oh, I heard about the Smith maneuver. That's what I want to do. I'm going to go do the Smith maneuver. They've got a mortgage from CIBC, Scotia, TD, wherever it is. And it's that traditional mortgage. It's that one line of 500,000, 700,000, 300, whatever it is. And they say, I want to do the Smith maneuver. So I'm going to go talk to my bank and say, hey, will you give me a HELOC? And the bank says, okay, based on your income, your numbers, sure, we'll give you a HELOC of 100 grand. Wonderful. Now they've slapped this HELOC in second position beside that traditional mortgage. And that client can pull out that money and they can do whatever they want with it. They'll go and invest it somewhere, maybe investment real estate or stocks, bonds, whatever. But the problem is, once I pulled that $100,000 out and got it invested, that's done. I can't access any more because it's not a re-advanceable mortgage, which is what they need. They need that when they go to make their first mortgage payment after they've slapped that HELOC on their home and got it out to invest, the next mortgage payment they make is going to reduce the principal, but the limit on the HELOC is not going to increase, right? They're not attached. They don't speak to each other. And if the client wants to access more equity, then after a year and a half, when it makes sense to actually go through the process to ask their bank to increase the HELOC limit, they got to go through the rigmarole, expense of appraisal, documentation, all that stuff. And then maybe the bank says, yeah, okay, we gave you 100 grand a year and a half ago, 2 years ago, we'll give you an additional 50. Well, if you have the re-advanceable mortgage, you don't have to do that because yes, they can access 100 grand right off the bat after Kelly gets your client refied, they can get it invested. But the next month after that mortgage payment goes down, that limit does increase, goes up to 100,001, and they can pull that $1,000 out and get it invested. So it's like they're refinancing their principal residence each and every month. without having to go through the expense of appraisal, legals, qualification, all that. Does the rental need to be in company name or is the homeowner name okay? A lot of investors, they have enough rental properties that it makes sense to incorporate. Now, when we're talking about the cash flow dam, which we went through, it's a little more complex if it's a corporation, because in the eyes of the CRA, I'm a homeowner and I have a corporation which owns rental properties. We are two separate legal entities. We are not the same. And so pulling money from my corporation is more complex than if I'm pulling money from my proprietorship. So if my rental property is owned in my own name as a proprietorship, and I can do this cash flow down with a home-based business as long as it's a proprietorship, because we're one entity, we're one legal entity. It's just that income that I'm receiving from that rental property is just classified the same as the income I get from employment, and I can do whatever I want with it. So you can implement the cash flow down with a corporation. This is where the accountants come in and say, is it worthwhile? Yes or no? It's a bit more complex. What would the referral fee, what would be a referral fee for a new client? I'm going to approach that question for as if the realtor were a Smith Maneuver certified professional and I was sending them a referral from a Canadian who was looking for an SMCP realtor in the Ottawa area, for example. There is no referral fee for that. There is an investment to become a Smith Maneuver certified professional, but once you're in, if anyone is looking for a realtor who's a Smith Maneuver certified professional, I just fire them off and away you go. How much is SMCP certification? I mean, I can touch base with Ken after this and give him a general overview, and he can spread that out for anybody who's interested. If a person has investment properties now, is it best to adopt this system at refinance time? The calculator used, can we use RSP as a debt swap? RSP, yes, technically you can. Well, you'd have to pull your money out from the RSP and incur taxation. Now, does that make sense? Maybe it does, maybe it doesn't. There's SMCP investment advisors, accountants who can look at that for your client. But generally, we don't use registered investments when we're going through the calculator with someone because it's a bit more complex on the tax side. But if a person has investment properties now, is it best to adopt this system at refinance time? Kelly can do the math. In a lot of cases, depending on rates, where they are now, where they were when your client initially signed up for that mortgage term, maybe it makes sense for them to break the mortgage and refi into a readvanceable through Kelly. Maybe it doesn't, but that is the math that Kelly can do for you. Kelly can do that math for you. Another mortgage broker who's not a Smith Maneuver certified professional can also do that math for you, but it's not going to be as accurate because that person is going to say, well, if you break now, get into another mortgage, considering the differences in the rates, penalty, and what you're going to pay and stuff, you're going to save $2,000 by breaking, or you're going to come out of pocket by $2,000 by breaking. So it's not worth it until the end of the term. But what that person, that non-SMCP broker doesn't know is that, yes, I may incur $2,000 of expense by breaking my mortgage and getting into the right one with Kelly, but we also have to add in the fact that if I don't incur that $2,000 expense, I'm not starting to generate tax deductions. I'm not getting invested $1,000 a month for the next 2.5 years, where I wouldn't be able to if I didn't break that mortgage. So there's some math to be done. Kelly's the one that can help out. It does increase with a little lag. I don't know what that means. Does the investment need to be made into a non-arm's length? Everyone is different. Every client is different. If I think about this question one way, I can, depending on who's actually, we've got a married couple, they're both on title to the house. Who's got the tax problem? If the wife has the tax problem, she's going to want to claim all the deductions, but they're both on title. So technically they're both borrowing to invest. Well, there's a way to get around that, not get around it by being sneaky, but you can be loaning that money, the guy with the husband without the tax problem can be loaning his half of that each and every month to his wife. The accountant can paper all that. How is it that no additional cash is required? Now, for those of you who are really paying attention here, you would realize that, okay, before I'm doing the Smith maneuver, I got a $3,000 mortgage payment. After I'm doing the Smith maneuver, I still have a $3,000 mortgage payment, but my balance on that line of credit is increasing each month, and I have to service the interest on that line of credit each month. So that means additional cash is required, $3,000 for the mortgage, and then whatever the interest only payment is on that line of credit. And so, Smith, how can it be that it's no new cash is required from my pocket? Well, the answer lies in the increasing efficiency of the regular mortgage payment. And you folks will know that the curve of I first get my mortgage each and every month, that mortgage balance, that line goes down very, very slowly, but then it starts to pick up pace. And over the course of 25 years, towards the end, is really going down fast. And that means the very first mortgage payment I make, the vast majority of it goes to interest, very little to principal. But each and every subsequent month, the amount that goes to interest is a bit less. The amount that goes to principal on my mortgage is a bit more. So let's say $1,000 goes down the very first mortgage payment. Line of credit limit opens up by 1,000. I get that invested. The next month, that principal by my mortgage payment is reduced to 1,003. So I can borrow back dollar for dollar, 1,003. $3 gets taken by the lender to service the interest on that line of credit, and I can still invest $1,000. Next month, 1,006 goes down. I borrow back 1,006. $6 goes to service the interest on that first 2 months borrowing on that HELOC, leaving 1,000 to invest. No new cash required from the pockets. Oh, how do you make LLC payments and the mortgage payment at the same time? I think I kind of answered that. Using a Smith Advisor accountant costs what for paperwork management? The SMCPs, an investment advisor who's an SMCP, an investment advisor who's not an SMCP, they have their own models for compensation, whether it's commission based as an advisor or whether it's fee for service. You don't expect any difference. They have gone out and gotten this certification. Now they do what they always have done for their clients. They charge the same as they always have done for their clients. They just have this additional knowledge to help their client with the strategy. And you don't have to expect any increased costs from the accountant. The accountant is doing what they always done. They just are specialized in making sure that they're claiming not too much, but not too little, and understanding the flow of funds and how to track that. So I think we've got all the questions so far. I'll throw one more in here. One we often get surprised. Well, I'm not surprised you didn't get it, but one we often get is the Smith maneuver legal? If it were not legal, there would not be 2 books written about it, 2 bestsellers written about it. It wouldn't be in continuous operation for the past 40 years. And we wouldn't be sitting here today. Yes, it is legal. It relies on the fundamental principle that if I borrow to invest with a reasonable expectation of generating income, I can deduct the interest. The wealthy have been deducting interest on money borrowed to invest for decades, if not centuries. Business, right? Now this opens up that same principle, the ability to deduct interest, to the rest of Canadians. Your average Canadian homeowner, your school teacher, your cop, your middle management, your city worker, right? All of these Canadians now have the ability to take advantage of tax deductible interest and compound growth like the wealthy have for years. Any concerns? Another one's come in about the CRA changing rules. Well, it goes back to what I just said. If the CRA ever came out and said, you know what, I'm sorry, you're not allowed to deduct interest on money you borrowed to invest with a reasonable expectation of generating income, that would not stand for long. I mean, any government that pulled that out of their hat would be kicked out in pretty rapidly. I'm pretty sure. Why? Because as I just mentioned, it's not just affecting your average Canadian homeowner who's now implementing the strategy. It's affecting the wealthy. This is why the wealthy are wealthy, because they understand debt. They understand there's two types of debt. There's bad non-deductible debt to buy our principal residence, to buy cars. There's good tax deductible debt. This is how the wealthy get wealthy. The wealthy don't have significant equity in their homes. They pulled it out to invest. They don't have a whole bunch of equity in their businesses. They pulled it out to invest. And if any government said, hey, you can't do that anymore, well, the wealthy business, they would make sure the government was gone pretty quick. Okay, that's it for now. Back to you, Kelly, Ken.
That's great. Thank you. That was fantastic. I hope everybody learned a lot today. And of course, I'm here to answer any questions after this as well. We can definitely go through the process and let you know what steps that need to be taken, information we require to go through that with you. And thank you very much for having us, Ken, today.
Oh, it was all my pleasure. My phone's been blowing up with people saying, "Oh, wow, this is awesome. Thank you for doing this. It's gold." So yeah, so thank you. There wasn't, this question and answer, but I don't think the chat was open. But anyway, phenomenal. Thank you, Robinson. That was amazing. I will connect with you. Kelly will connect us regarding the certification program and what that looks like. So I'll get that information to our agents if anybody's interested in that. If anybody's interested in the actual mortgages that are required, that type of mortgage, and which lenders provide that style of mortgage, Kelly Wilson is your contact, and we'll get out Kelly's information as well so that you can reach out to her. Just want to give gratitude. Thank you so much. You made it so simple, and I'm sure your calculator is only available to certified Smith Maneuver practitioners.
Here's the thing. It's available on our website. We've got the book, the calculator, and we've got a homeowners course for homeowners on the website. And so the general public does have access to that calculator. They can buy that calculator, but we're changing it. We're in the process of changing it right now so that Smith Maneuver certified professionals will only have access to that. The general public can buy a more simplified version, which gives them an idea and the impetus to say, okay, this is looking good based on the limited inputs I have here. I'm definitely going to go talk to an SMCP to get the asset, to get the results from the real one.
Yeah, awesome. Great. And look at that, you're a couple minutes early. I don't see any other new questions coming in. So thank you very much. This now concludes our webinar.